All right, team. Here we go. It's time for video 1 in the Professor Roddog lecture series. My voice is not well right now, but I'm ready to go. The first thing I want to talk to you about is this is a principles of accounting or financial accounting, intro to financial accounting lecture. We're going to be covering 25 to 35% of the material in your typical sophomore level financial accounting class in the first 3 to 4 series or videos. This is video 1. Roddog lectures. Why do we need accounting? I've created this basic representation here where accounting is in the past. Doesn't mean we don't look forward, ahead of now. Finance, we have financial planning, analysis, forecasting, treasury, budgeting. Treasury's over here as well, but that's because we have cross-function, hybrids, areas that can be in either side depending on the company. But we're going to focus on accounting and financial accounting, recording transactions that are based on economic or financial events. Now, that's the purpose. What's the purpose of accounting? We need to record financial or economic events, and we need to journalize them. I'm going to show you how to journalize things. I'm going to show you what's behind QuickBooks, what's the software coding behind any sort of software. We do write it out. It is somewhat tedious, but it's relying on QuickBooks can be one methodology, but to truly learn accounting and its effects on the other part of the business, we need to understand the guts. So, we have 3 main business types: sole proprietorships, partnerships, corporations. Audit firms, accounting firms, law firms. Partnerships could be you and 2 friends get together, pick your partners wisely in business, and you start a company. You each own 100 shares. There's 300 shares outstanding, and you're all third partners. You could have a scenario where you have 1 50 or 60% partner, and then 2 or 3 or 4, 10, 20, 15% partners, depending on how you structure it. Corporations, I like to think of publicly traded companies, although there can be private companies. Apple, Google, Walmart, Costco, Nike, Under Armour. We'll take a look at Under Armour's financial statements during this session. So, with that, I want to disclose to you that accounting is an alien language. It's an alien language because it has its own system, it has its own terminologies, it has its own nomenclature, and if you'll trust me, it's very logical. Accounting has a lot of balancing where things equal each other. Accounting is much more law-based than it is math-based. So if you're interested in being an accounting major, being good at math is good, but this isn't calculus. We're going to be doing mostly basic algebra, and it's more law-based because I'm going to tell you later why it's more law-based. What's in an accounting transaction? Well, we have a financial or economic event that happens, and we need to record it. We need to record this transaction. So I'm going to get right into it. We have debits and credits. DR represents debit. CR represents credit. We're going to journalize items or what is actually happening in an economic event in this manner, and I'll show you. What's involved in an accounting transaction? We have 5 main account types when we're recording a financial or economic transaction, when we're doing accounting, when we're journalizing a transaction or event. So, the first one, assets. What are our asset types? Cash, accounts receivable, equipment, inventory. Does Costco and Walmart have a lot of inventory? They sure do. Waiting to sell it to you so they can have all your money. liabilities, accounts payable, notes payable, stockholders' equity. We could also call it owner's equity, but we'll call it stockholders' equity going forward, unless I slip up. And these are 3 of our 5 main account types. Let's do an example. We start a company, Roddog Golf. We sell golf clubs, golf balls, golf gloves, tees. I'll sell you a photo of me swinging a golf club for millions of dollars. I also provide golf lessons, so I have product revenues and I have service revenues where you're paying me lots of money to teach you how to hit a driver like me, which is not that impressive. But let's say I get 2 partners that are really good at golf. I'm really good at golf too, wink wink. And we become partners, and we each have to contribute $10,000 to the company to start Roddog Golf. Well, here's how we're already gonna do a transaction. On January 1st, 2018, we debit cash, we credit common stock. Each of us has 100 shares of stock. That money is now the company's. It's not mine. My partners and I have to decide on how we're gonna use it, but that is now the company's money. Well, what did I get in return? I got some stock, some shares, or the operating agreement of the company dictates, we each have 100 shares. So we're equal owners and such, but I got stock in exchange for my cash. This is now Roddog Golf's cash. So, assets, we had cash, and we credited common stock. Let's do one more. A month later, we borrow some money. We're really already getting this thing going. I put my 1987 Geo Metro as collateral. That's funny, people. For this $10,000 bank note. I've put hydraulics and a $5,000 stereo system in my Geo Metro. So it's a sweet ride. How do I account for this transaction? Well, we have a liability involved. The company gets cash. The bank gave us $10,000 cash. We increased cash. Man, I'm already seeing a pattern here. To increase cash, I need to debit it. And then we credit notes payable this time. We increased an asset. And we increased stockholders' equity. Here, we increased asset, the plus asset, and we also, I should actually do a dot. Yeah, that'll be easier. We increased the liability. I'm going to guess that to increase the liability, I need to credit it all the time. I'm already teaching you the alien language of accounting. Now, here we are. What's our 4th and 5th? We have 1, 2, I'm going to change colors. Don't be mad at me. I'll do a different shade. I want to do a different shade. Whatever, I give up. And then 1, 2, 3, and then we have 4, 5 here. Let's go green and red, whatever. I'm making this harder than it is. I give up. 1, 2, 3, 4, 5. We've got 5 types of accounts. All right, fine. I'm going to do this all the way. It's starting to bother me. There we go. I said we have 5 main account types in our alien account language to help us journalize, record transactions that happen in business. This is a partnership that we're in here, the 3 partners of Roddog Golf, and I've already illustrated 2 journal entries for you. These are called journal entries. What are they doing? This is recording and accounting for the economic transaction of us starting the company and contributing cash and being equal shareholders. And this is accounting for the fact that we took out a bank loan, $10,000. Now, I want to introduce you, now that I've introduced you to 5 revenues and expenses. What are the common expenses for Roddog Golf? or revenues and expenses. We're going to have golf ball revenue, golf club revenue, golf accessory revenues, and then we're going to have golf lesson revenue, which is a service revenue. It's not a product, right? I'm not handing you a product. I'm actually coming to the range with you or going out golfing with you and giving you lessons. So, expenses, wages expense, interest expense. We'll take a quick look at the way Under Armour shows it. But wages expense, interest expense, rent expense, utilities expense, cost of goods sold, which is the inventory cost when we sell it. Got a bunch of expenses here. Let's go to financial statements. This is really important. We have four main financial statements: income statement, statement of retained earnings, balance sheet, and statement of cash flow. Income statement, revenues minus expenses equals net income. Statement of retained earnings, beginning balance, which is zero because we just started the company. This is the retained profits in the business. Add net income, well, we got that from the income statement, less dividends equals the ending balance of retained earnings. Dividends are if we made money, me and the two other partners, and we wanted to take some of the profits out of the business outside of our normal wages. Dividends are not an expense. They're a part of equity or retained earnings here. When you go to the balance sheet, we talked about assets, liabilities, stockholders' equity. Assets equals liabilities plus stockholders' equity. We call that the accounting equation or the balance sheet equation. Assets, cash, accounts receivable, inventory, equipment, liabilities, accounts payable, notes payable, unearned revenues, which we'll talk about later. Stockholders' equity has two main components to start this class: common stock and retained earnings. Well, where did retained earnings come from? Right here. We had to have this number because retained earnings is one of the two sub-accounts of stockholders' equity. Common stock, which we dealt with here. What's common stock? We had $30,000 of common stock because we contributed $10,000 each. Retained earnings is the retained profits, meaning what we had in income less what we paid out to the partners as a dividend. Equals our ending balance. We use that to finish the balance sheet. Do you see why we need to do the income statement first? Because we need this number here, and we need to do the statement of retained earnings next because we need this number here. I'm not going to go into the statement of cash flows much. We have operating activities, investing activities, financing activities. Buying equipment, selling equipment, our standard selling golf clubs, selling golf balls, golf lessons, and our operating expenses. Financing activities is like the common stock and banknote transaction we did. Those are financing activities. We're going to leave it at that. Probably in lecture 8 or 9 or 10, whatever it ends up being, we will have a full, long 45-minute session on, or 2 45-minute sessions on this, but for now we're going to shelve it. We need a bunch of the pieces of this to do the statement of cash flows, which is why it has to be done last. We need to do these 3 financial statements to be able to do the statement of cash flows. You just have to trust me at this point. Okay, in the United States, we have the Securities and Exchange Commission. You can Google this stuff. The SEC is in charge of publicly traded companies, our capital markets, right? Our stock exchanges where these publicly traded companies, their stocks are traded. The SEC requires publicly traded companies to publish quarterly and annual financial statements. We're going to focus on the annual report, which is the annual, 12-month financial statements. And we'll see some complicated stuff that we won't go into, but you'll actually see a lot of what we've talked about here and what we look at. We're going to look mostly at the income statement and the balance sheet. We'll spend most of our time in these 2 financial statements for the record. The Securities and Exchange Commission, the Financial Accounting Standards Board, is a body that's been created to help the rulemaking process for accounting transactions. We have to play by the same rules, right? Companies in the same industry should be following the same rules. All publicly traded companies need to follow GAAP, generally accepted accounting principles. There's a lot that goes into GAAP, but this is a good sequencing for you to look at and research. We'll use this GAAP word. What does GAAP mean? The accounting rules that we have to follow, the way we have to transact financial or economic events. In the world, or non-US, we have plenty of one-offs as well, but we have the International Accounting Standards Board and International Financial Reporting Standards. My professors told me in the late 90s and early 2000s how we would converge. We always were talking about convergence. We're never going to converge. I should never say never. It's not going to happen. So don't let people tell you that. Our capital markets are unique. They're mature. We have specific rule-making bodies and processes that can't be replaced by a world body. Why is this important? It's important because if we're a multinational publicly traded company, or a private company for that matter, we can have our U.S. operations doing their accounting in GAAP, and the Germany office or Serbia office, or name your favorite country, the Ghana office or the India office or the China office could be doing things in IFRS. We have to deal with these differences so that we can understand our financial statements comprehensively. I've made that really simple, but that will suffice for this lecture and class. I'm going to end there, wrap up this first video, and we'll be right back with more. I'm going to go get a drink and we'll go from there. Roddog Lectures, video 1, over and out.